Good morning and welcome to Anchin Block and Anchin's webinar, Avoiding the Most Common Employee Benefit Plan Failures. My name is Deborah Vries and I'm a partner in the Compensation and Benefits Services Group at Anchin. I am joined by Fred Barotz, a tax director in the group. Before we begin, there are a few housekeeping items I would like to review. This webinar will last around an hour. If we have time near the end, we will field questions. To ask a question, locate the Q&A window to the right of the presentation slides and type your question in the lower box before clicking Submit. Please note that you can rearrange the windows by clicking the bar at the top, holding and dragging them to a new location, and you can resize the windows by hovering over the bottom right-hand corner of each window and clicking and dragging once you see the arrows appear. If we run out of time before answering your question during the webinar, we will follow up afterwards with an email to you. Our contact details will be provided near the end as well. This webinar is being recorded, and we will send you a link to replay or share it with your colleagues and friends. If you require technical assistance during this webinar, please let us know in the Q&A box. We will be monitoring this during the event. During the webinar, there will be polling questions for you to answer. For those who would like to earn CPE credit, you must answer these polling questions to receive your certificate. After you have completed the requirements, you will be able to download your CPE certificate from the certification window at the end of the presentation. For this reason, we will not be emailing certificates unless you notify us that you've had trouble with the download. So let's begin. So my experience in the area comes primarily from performing audits of planned financial statements. As you may or may not know, audited financial statements are required to be attached to the Form 5500 filings of large plans. Invariably, we do find problems on the plans that require an audit for the first time after crossing the threshold and becoming a large plan, and also those we take over from other auditors. This morning, the focus will be on 401k plans, as overall they're more prevalent this day and age, and it's what we see the most in our audit practice and presumably will impact most of you directly. The issues we are addressing are the most prevalent and recurring ones we see, but the list is definitely not all-inclusive. You may also be concerned about what happens during an IRS or DOL examination. The common failures we'll talk about are also the major items that the IRS and DOL look at during their examinations. So by being aware of the common plan failures, you can protect your plan and will be ready in the event of an examination. Then after I've gone through all of that, Fred will save the day and tell you how you can correct errors once you find them. So as an overview, we will discuss why are there plan failures, why should you care about them, the most common failures, how to prevent failures, as well as corrective action.
We're going to start with our first polling question. We just like to get a feel for how many of you actually have a filing requirement whereby you need audited financial statements attached to your Form 5500. Generally, that'll apply to large plans, which are plans with more than 100 participants. So if you just let us know, yes, no, if you're not sure, there's an option for that. And if you don't have a plan in place, please check the fourth option. So it looks like the preponderance of you actually have no audit requirement in place, which means that you're a small plan. That is the largest response. That means you do not have audited financial statements and you don't have accountants coming in to do an audit. So this hopefully will be a valuable experience for you because it's going to help you self-administer your plan a little bit better and look at the possible plan failures that possibly an auditor would have done for you if you had a large plan. Yep.
So let's take a look. Why are there plan failures? Now, we've come up with a few items based on our experience that we think are the top items that contribute to plan failures. The first is excessive responsibility is given to a lower level person. In many instances, this person was not trained on the employee benefit side. They happen to be working in the HR department, in the payroll department, and kind of ended up with this responsibility. So we see that many times as one of the primary reasons that you find problems in a plan. Secondly, we see that sometimes the plan is not someone's primary responsibility, so then it's not a priority. Unfortunately, as you may all know, the actual job of monitoring the plan is many times given to someone that already has a full-time position at the company. So there's just enough time to keep it running, but not necessarily dig in and ensure that it's running in accordance with the plan document. We've also seen instances where there's a fast-growing company. Many times when a company is taking off, the last thing to catch up are the internal support groups such as HR and finance, with the number of people needed to support the increased transactions and people flowing through the system. So during that time, in the rush to just keep up, things slip through the cracks. You forget to enroll someone, you don't process a participant request, or you process it incorrectly or possibly not timely. And lastly, we see that sometimes mistakes just happen. Even the best run organization with the best structure and departments set up segregation of duties and people in place that know the plan document, mistakes can happen. And that could be as simple as just a clerical error. So why should you in the audience, why should you even care about plan failures? The first is you have a fiduciary responsibility. So the plan sponsor, and particularly those involved with the plan, have a fiduciary responsibility to the plan. The fiduciaries have important responsibilities and are subject to standards of conduct to act solely on behalf of the participants and their beneficiaries. So think about the state of our retirement system in general right now. The DOL in particular and the IRS are concerned and want to ensure those eligible are given the opportunity to participate and ultimately receive the benefits entitled to them. So as a fiduciary, you must carry out your duties prudently, follow the plan document, diversify the plan investments, and pay only reasonable plan expenses. And those that don't follow the basic standards of conduct may be personally liable. So that's where you might want to consider some type of fiduciary liability insurance as an option as well. And another reason to care is that an operational error, which means you're not following the plan document, could lead to plan disqualification and the trust becomes taxable. Of course, no one at the IRS or the DOL really want this to happen, and that's why they perform their own examinations as well, as provide those correction programs that Fred is going to go through later, so you can correct any mistakes that do happen. Secondly, if you're not in compliance and you have to make corrections, it could impact your budget and possibly significantly. No one likes a surprise like this, especially the owners, because it ends up coming right out of their pockets. And you will see, based on the failures we discuss, how some of them could be significant. So let's get started going through the most common plan failures. Once again, we've only selected 7 failures to discuss, as these are the ones we see most often and they also make IRS's top 10 list. So the first is the failure to follow the plan's definition of compensation for determining contributions. This is bar none the most common failure. The plan document has a definition of compensation for determining contributions and benefits, but they also have a definition for performing the non-discrimination testing, and these two could be different. So you could easily pick up the wrong definition to use in applying it to the contributions. There are many different definitions of compensation that can be used in a plan document, and many times the definition refers to an IRS code section, so it's not clear and in layman's terms. The most common starting points are either Form W-2 wages or 3401A wages, which is federal income tax withholding wages. So that's the first obstacle. What is your starting point? And then the next question is, are there any additions or exclusions to those amounts? Some common exclusions are bonuses, commissions, overtime, and a common inclusion would be an add back of the employee's deferrals. And of course, all of this is subject to the annual compensation limit, which is $265,000 for both 2015 and 2016. Some plans, rather than excluding the bonuses entirely, they give the participant an option to include it. And that's only if it's not included in the compensation definition. Or they give you an option to exclude it if it is included in the definition. So let's step back. You use compensation as defined to calculate the employee deferrals. So if the deferral is based on a percentage of compensation, this is where you could run into trouble. If the participant elects a dollar election, then you're home free on this part. Compensation also relates to the employer's match calculation and any profit sharing contributions as well. So if bonuses are improperly excluded, what you would need to do to correct this is you would need to contribute 100% of that missed match and profit sharing amount and 50% of the missed deferral amount, and both of those amounts plus any missed earnings between the date that it should have been funded versus when it actually ended up being funded. Then what you have to do is you have to think, this just happened this year, or is this something that's gone back years? And you have to go back to as far as when it was not happening, and you have to make the corrections back that far as well. Calculations can be very complex, especially when it relates to the deferral percentages, because participants may change that over time. They don't necessarily select, let's say, 5% through the whole life of their participation in the plan. So at one point, we had a client with a sizable plan, and they excluded bonuses and other items from compensation for 4 years. And what happened was they always paid bonuses at year end, and the system was set up to calculate on those bonuses. And 1 year, they started paying the major bonuses at the end of the third quarter, and this was not coded correctly to be picked up, and no one was doing any test checking to make sure it was done right. And the correction ended up costing them $500,000, plus the cost of the ERISA attorney and other providers to assist with the calculation. And then on top of that, you have all the internal time spent to get the information together for the calculations. So there are these issues with interpreting or applying the definition properly, but also we've seen where the plan has been amended and the definition's been changed, but you're still operating under the old definition. This can happen when you're filling out the adoption agreement for a prototype plan. Someone should be checking that the answers still result in the same provisions as under the old plan if that's what you're trying to accomplish. We've also seen where a change of payroll providers is not properly set up to pick up all the components of compensation. We had a client where they changed payroll providers. They commonly issued second checks for overtime for whatever reason, but that wasn't properly coded under the new payroll to have 401k deferrals calculated on it, as well as the related match. Luckily, it was the first year we were auditing the plan that this change occurred, and we picked it up right away, and they were able to correct it and remit the amounts due to the plan. The question is, what does the plan document definition translate to versus what are you doing? I mean, when we have a new situation, we spend time reading the document and coming up with what we think the definition translates to, and we'll bounce it off each other here just to make sure we're reaching the right conclusion, because it usually is not clear cut. Also, you should consider doing a test check of 5 different types of employees: a new employee, an old employee, highly compensated, not highly compensated, and take their compensation for the annual period as defined and multiply by their deferral percentage, and do a recheck of their deferral and employer contributions to make sure it was done correctly.
So the takeaway here is that while the IRS does offer you considerable latitude in how you want to define compensation and how you want to customize your own plan, that can kind of come back to haunt you if you're not proceeding in your plan in accordance with your own plan document. And I can tell you that the IRS is certainly aware of this, and when they do audits of plans, they will look at how your plan is running, how the match is being done, how contributions are being remitted, they'll have a copy of your plan document in hand, and they will look at how you define compensation and compare it to what you're actually doing. And as Deb said, it's very easy to go wrong, especially something like bonuses. Let's say you have a regular payroll where plan contributions are remitted every 2 weeks or twice a month, but a bonus payroll might be a manual check, could be a special payroll, and it's not properly coded to have a match or not properly coded to allow for a plan contribution. This could go on for quite some time. Oddly enough, employees often don't notice and nobody tells you, and then it gets discovered down the road. If you have a situation like Deb was describing, where you have a large plan that needs audited financial statements, it's possible your accountant will pick up on this. But if you have a small plan, no audited financials, it's really going to be doubly important for you to work in conjunction with your plan administrator to ensure that what you're doing in terms of plan compensation follows the definition that's in your plan document, especially if any changes have been made.
So the next item we will go over is the failure to include eligible employees in the plan or failure to exclude ineligible employees from the plan. So in general, an employee must be allowed to participate in the plan once he or she reaches age 21 and completes at least 1 year of service. Plans may allow employees to participate earlier, but may not be any more restrictive than the federal tax law allows. The plan document will define which employees are eligible to participate in the plan. Maybe it's all employees except part-timers or those covered under a collective bargaining agreement. Those are the major exclusions that we usually see. The criteria may also be different for each type of contribution. For employee deferrals, you may have automatic enrollment. So employees become immediately eligible at a set percentage unless they change it. Employees may become eligible after a service requirement is met. But you also might have additional stepping stones that once eligible, entry dates are only monthly or quarterly. So if you let one person in early, it seems like no big deal. We didn't hurt them and not allow them to do something. But the problem is we gave that person an opportunity not afforded to everyone else. So that's what the problem is. And technically, that early contribution and earnings has to go back to the employee out of the plan. Conversely, if someone became eligible and elected to participate, but did not enter on time, they missed an opportunity. So that has to be made up to them. And that's that 50% of the missed deferral plus any missed earnings between the time it should have been deposited versus when it was funded. And you also have to note that eligibility requirements for employer contributions could include a service requirement, an hours requirement, or a requirement to be employed on the last day of the year. Any errors in practice versus the correct calculation should be corrected. So it's extremely important to maintain good employee information. That includes the hire date, eligibility date, and entry date for each type of contribution. It's important to think about when does an employee become eligible and how are they notified that they're eligible? Is it done electronically by the TPA or by you? And can you prove it? And what is the procedure for someone to enter the plan and then for the deferral to be reflected in payroll? Is there too much of a lag in the application of the deferral? And this goes for changes in deferral percentages as well. Do you get something from the TPA that says these 5 people changed their deferral elections, then it goes to the payroll person to make the changes? Is then the payroll change report compared to the TPA change report by another person to make sure it was properly done? Also, how do you handle employees that opt out? Do they fill out an opt-out form so you know that you have everyone covered? Or do you just enter them into the plan at 0% so that you know that you've accounted for everyone and then you put it into their hands and it's their responsibility to go in and make any changes? So this is one of the reasons I do like auto enrollment, because not only does it help increase plan participation and enhance retirement outcomes among participants, it also improves discrimination testing results, but it also puts everyone into the plan so you know you have accounted for everyone, and then the participant has to change their deferral percentage. But there could be an increased administrative burden So obviously it has to be thought through. Next, let's talk about the failure to amend the plan for tax law changes by the end of the period required by law. This results in a plan failing to operate in accordance with the current law because the plan document has not been amended to effect such change. If you've adopted a prototype plan, you should receive all the documents from the TPA to sign, and you need to make sure to execute and return them timely. If, on the other hand, you have an individually designed plan, you should have a risk counsel in order to advise you of any required changes and to prepare the amendments.
Surprisingly, IRS agents place an unusual amount of focus not only on whether a plan has been amended to capture all of the required tax law changes during the amendment cycle, which is generally 5 to 6 years. They also look a little bit at form over substance, which is to say they insist that the amended plan be signed by everyone it's supposed to be signed by and dated when it's supposed to be dated by a certain deadline. So if you hand them an amended and restated plan and it's not properly executed, signed, and dated, they will consider your plan to not having been timely amended. And you end up with a bad situation just because a clerical item wasn't done. So it's important to get these things done and then to also cross the T's and dot the I's with properly executing the plan. That's going to take us into our next polling question. We'd like to know if your plan actually uses an outside third-party plan administrator. Hopefully, if you're one of the larger plans, you do. Certainly that gets you in a very good place. I see already the great majority of you are using a plan administrator, and that's great because that takes the burden away from you and puts it on the plan administrator to ensure that you're capturing all of the required amendments to a plan. You don't have to think about it, they go to you. That's really an excellent thing to have going. I do note that some questions have already come in. We can't see what they are yet, but we will set time aside at the end to take questions as time permits. So why don't we move on? Thank you for answering the polling question. And back to more common plan failures.
So next we will move on to the failure to satisfy plan loan provisions. First, you need to ensure that your plan document permits loans to participants. Sometimes the loan provisions are within the plan document, and other times the document refers to a separate written loan program. The federal tax law has rules to prevent the law from treating the loan as a taxable distribution to the participant. And the plan document can be more restrictive, but not less restrictive than the federal tax law. So examples are you need to have a loan document. The loan amount cannot be greater than 50% of the vested account to a maximum of $50,000. And there should be level amortization payments at least quarterly. Loan failures often result from the plan sponsor's failure to withhold the loan repayments from the participants. The loan is considered defaulted, and the participant should be taxed on the loan in the year of default. Most non-payments are due to terminations, although we have been seeing amendments lately allowing payments to continue after someone is terminated or leaves the company. If there is a cure period in the agreement, which could be at the end of the calendar quarter that the payment was missed, if the company forgot to collect, the employee can make the missed payments and continue on with the amortization table as it was set up. If there's no cure period, then it's actually considered a deemed distribution and taxable to the participant. It is a plan failure, but it can be corrected through one of the correction programs. Some other things just to note about loans. If a loan is for the purchase of a primary residence and extended terms are given, you should ensure that the plan allows for it. And another thing that I want to address is e-certification by the third-party administrator. In the instance of needing documentation for this primary residence purchase, someone has to maintain those documents. And when a participant goes in and e-certifies, meaning they go into the website of the TPA and say, I'm purchasing a home, they may or may not provide those documents to the TPA. And if they do, many times those documents are not retained by the TPA. So if the document is not being retained by the TPA, then you as a plan sponsor should be the one retaining it. So it's important that you understand what the TPA is doing versus what you need to do, because we really tend to rely on the TPA with the e-certification process. And just so you know, in many instances, you could even turn off the e-certify feature so that you get the documents automatically and there's no misunderstanding of who's doing what. And also you should make sure you understand when you're being notified that a participant took out a loan and the procedure to ensure that the proper amounts for repayment are withheld from payroll timely, which will address these instances when the amounts are not being withheld timely. Next, we'll move on to impermissible in-service withdrawals. So the law provides that distributions to participants can be made upon certain events or attainment of a certain age. Most plans will see the age 59.5 as the specific age, and certain events are usually severance from employment, death, disability, or the plan sponsor terminating the plan without maintaining a successor plan. Some plans limit in-service withdrawals to either the vested employer match amount, any rollover amounts that came into the plan, or employee contributions plus earnings. And also note that many plans now require spousal consent. And there should be a place upon initially entering the plan where the participant represents they are single, divorced, married, etc. And this is where you would check to determine if the spousal consent is needed, assuming the plan requires it. So the failure is when a participant receives a distribution where the plan or law did not allow it. If the participant is under 59.5, the withdrawal is ordinary income and is subject to 10% early withdrawal penalty. But a permitted in-service withdrawal is a hardship withdrawal, which we'll talk about next. So a common failure is that a hardship distribution is not in accordance with the plan document. Many times it's found that a plan made a hardship distribution even though the plan document did not permit it. Also, plans that allow hardships but don't follow the plan document specific hardship criteria, and they distribute the money for another reason that's not necessarily specified in the plan as an allowable reason. And once again, the document can be more restrictive than what's allowed by law. A hardship really can only be made because of a participant's immediate and heavy financial need, and should only be made in an amount necessary to satisfy that need. There's a list of common examples, but some of them are medical expenses, cost related to purchase of a principal residence, tuition, and a bunch of other items are permissible. The plan document may require exhausting other means, including taking a plan loan, before you're allowed to even take a hardship. Also, if the employee has other resources available to meet that need, including assets of the employee's spouse and minor children, that should also be taken into consideration. But the plan sponsor, once again, is responsible for verifying the hardship requests, and that same e-certification issue applies as it did with the loans that we just spoke about.
Another reason to consider this an avenue of last resort is, don't forget, if you draw down on your plan balance, it's going to be taxable income to the plan participant, and even though it's a hardship distribution, it is usually going to be subject to a 10% early withdrawal penalty if the participant is under age 59.5. So if the distribution is taxed on the federal level, the state level, and possibly a local level, if let's say they're a New York City resident, and on top of all that, you put a 10% early withdrawal penalty, you could lose conceivably in the neighborhood of 50% of your hardship distribution, which is really the last time you can afford something like that. So whether you're required to or not, it's probably better to look to other financial resources or a loan from the plan if you can, and that's going to avoid something that kind of comes close to confiscatory, where you lose up to half the money in your hardship withdrawal.
So lastly, we will talk about the failure to transmit to the plan any participant contributions within the prescribed time period. This has been a DOL hot button for a very, very long time. Once you withhold employee deferral money, it must be remitted to the plan. If you're a small plan with less than 100 participants, there is a safe harbor of 7 to 10 business days to remit the funds to the plan. But for a large plan, there is no safe harbor. You must do it as soon as administratively feasible. And I think that term usually confuses people. What is administratively feasible? It's as soon as you can get that money into the plan. And now, in the day and age of electronic transmission of payroll taxes, that sometimes is a guideline. You may need another day to do some type of reconciliation as it relates to your deferrals. That's fine. But as long as you have a policy and procedure in place, and if someone's out sick, you have someone to replace that person so that you maintain this policy and the amounts are going in about the same time every pay period. If the payments are not considered timely, it's an operational error and it gives rise to plan disqualification and is also a prohibited transaction. And if it's a prohibited transaction, it's reported on the Form 5500 and the financial statements, and also an excise tax return is required to be filed.
It may sound like I'm repeating myself a little bit, but this is certainly an IRS focal point, and I've seen it over and over in handling tax exams with the IRS. We did have a situation where one of our clients had a biweekly payroll that was done on a Thursday, and the agent actually considered it generous to okay the transmission of funds to the plan the following Monday, as opposed to the very next day, which was Friday. So 4 calendar days, which spanned a weekend, was considered a generous time period to remit plan contributions. As Deb said, in this age of electronic transmissions of funds everywhere, including payroll taxes, the expectation is if you can get your payroll taxes in the next day, if you can pay your employees immediately, you should certainly be able to fund the plan with their contributions immediately. So you don't want to be waiting a week or 10 days or 2 weeks to do this because, as Deb described, there are a lot of consequences for late contributions to the plan.
So now that we've covered several failures, let's discuss how to prevent the failures. The first is you must understand the plan document provisions. And in order to do that, you have to read the document and compare it to what you're doing. And it's important, if you do not understand the provisions of the document or how to work through the definition of compensation, please speak to your third-party administrator, your accountant, your ERISA attorney to clarify and make sure that you are doing it properly. Secondly, you should set up policies, procedures, and internal controls. You need to look at each area of the plan, contributions, benefit payments, loans, etc., and determine how the plan document says it should work and map out how it flows through the system. It's important also to understand what is done electronically and how the information goes between providers and if there's any room for clerical error during any of those processes. Next, you could perform a self-audit. You do some self-checks of calculations and make sure that you have any supporting documentation where it's required. And Fred will go through some self-audit procedures later on. Also, it's important to have a qualified internal person responsible for the plan and operation. It has to be someone that has the time to do these things or to set up the proper delegation and checks and balances in order to accomplish these things. And lastly, hire qualified outside service providers and consultants. And you also need to understand what your providers are providing and what you're still expected to be doing. You can delegate some of the work, but you really still have to be checking it because at the end of the day, you're the one that's responsible for the plan.
We have another polling question for you at this point, and then we'll get into solutions to problems. Has your plan actually been updated within the past 5 years, which tends to be the remedial cycle that the IRS demands? Not getting too many responses yet, so let's wait a few seconds. So what we're seeing is about 41% are saying that it has been amended and restated, which means 60% of you or 55% of you have not. Um, you may want to check with your plan administrator on this point, since if you have a customized plan, there is a requirement to have your plan amended and restated every 5 years. So you should be somewhere in that cycle right now. If you have a so-called prototype plan, which means your plan is with, let's say, a brokerage like Fidelity, it's a 6-year cycle. But if you're in that group that you're not sure or it hasn't been amended and restated, that's something you're going to want to check on to make sure that you've captured all the required law changes within the past 5 or 6 years. So why don't we move on and talk about solutions to problems. So what we're going to do is we'll start by addressing solutions to the issues that Deb has braved over the past half hour. We're also going to talk about what happens if your tax return, Form 5500, is filed late or you missed the deadline. What do you do? We've referred a little bit to audits of plans by the Department of Labor and the IRS. So we'll talk about what to do if you're contacted by either of those agencies. There's also such a thing called non-qualified plans, and those can be audited as well. Now, the term non-qualified, it may sound like there's something wrong. It does not mean there's something wrong. Non-qualified simply means that your plan is not governed by the laws of ERISA. There's no tax return, no 5500 to file, but even an employment agreement is an employee benefit plan, and as such, it can be audited by the IRS. Even your health plan can be audited. You have a contract with a major healthcare provider. It's a health plan, that's an employee benefit plan. The IRS can come in and audit that. So let's talk about all those things, starting with the plan failure solutions. Now, there's an ongoing correction program that has 3 levels. And the first, the lowest, and best of those 3 levels is called the Self-Correction Program, or SCP. And that's where everybody wants to be. Because if you actually skip to the last bullet point there, correcting the plan failure isn't much more than a memo to the file. What that means is you're going to write up what the plan failure was, why it happened, and what steps are being taken to ensure that that doesn't recur. So the best thing here is you don't really have to tell anybody about your error, and that's why it's called self-correction. So when can you use that? Unfortunately, there's no bright line test as to when you can use it. There are some times when you cannot. It's really facts and circumstances, and it's going to depend on the size of the error, how many people are affected, and how long it's been going on. So if you have a very small error, but it hit a lot of people for a lot of years, you may cross out of the boundary whereby self-correction is allowable. Conversely, you might have only one error one time, but it could be a major error, and that's also going to take you out of self-correction. So really, if there's any doubt as to whether you qualify here, you'll want to talk to your ERISA counsel. Unfortunately, some plans are explicitly excluded from self-correction, such as late remittances to the plan, which we've talked about at some length. So if you have done that, or if you have any other plan failure that is too big or too frequent or hitting too many participants and you cannot qualify for self-correction, you're going to want to move on to the next of the 3 levels of plan correction programs. And this is called the Voluntary Correction Program, or VCP. This looks daunting. It actually is, but you're not going to have to do it yourself. Probably you're going to bring your ERISA counsel in to do this for you. It's a long, formal application to the IRS. There is a fee involved to the IRS for submitting the application, as well as obviously a fee to your ERISA counsel for preparing it. there is a lengthy waiting period for approval, which, if nothing else, tells you that there's an awful lot of plan failures going on out there, and that's creating a backlog at the IRS. But the good news is, even though you may have to wait 6 months or 9 months or a year to hear back, there's a very high success rate. As a matter of fact, in my experience, I've actually never seen one of these denied. So if you're in BCP, it's a little bit more expensive than self-correction, but you should be able to cure your problem at this level. Deb just has a comment now regarding the financial statement aspects of this process.
Right. So if you're at a point where you will be filing under BCP or have already done so at the financial statement period that you are issuing, number one, you'll probably have to accrue for some type of amount that may be due with it. And then some failures obviously may not have an amount due, but it's an error that needs to be corrected. And in either case, you would have a financial statement footnote, probably shown as an operational error, that will describe, exactly what happened and that you have filed with a BCP application or that you plan to. But one thing to note is the DOL hates seeing I will many years in a row. Maybe the first year, maybe the second year, but you really need to get that application filed as soon as possible.
Now, the third level of correction program is not a real good place to be. That's called the Audit CAP program, which stands for Audit Closing Agreement Program. And this is what happens when you haven't come forward to correct an error through self-correction or voluntary correction. This is when the IRS comes to you. So when that happens, you really don't have any leverage anymore because you haven't come forward and gotten in front of the problem. So in this situation, so-called monetary sanctions apply. They probably will fine you for your error. The good news is the sanctions can be negotiable, but the bad news is they can be significant. So if nothing else, that tells us it's better to get in front of the problems, and we'll talk a little bit more about that later when we talk about how to do a self-audit of your plan and see if you need to be in any of the correction programs. I'd like to touch on late filings of Form 5500. Some of our well-meaning clients in the past have found that their 5500 was late and they would rather be a week late than a month late, so they think, let's just go ahead and get it in as soon as we can, even though it's late. And that's actually a mistake, because if you don't get into, if you look at the third bullet point, the DFVC, or Delinquent Filer Voluntary Correction Program, sending in your return late, and it's done electronically these days, so they know immediately if you're e-filing late. The IRS can penalize you, and they will, up to $15,000 for a late return. And the Department of Labor, believe it or not, can penalize you $1,100 per day. It's possible to get these amounts down by sending in reasonable cause statements, but you really don't want to be trying to get out from under penalties like this. What you need to do if you have a late return is you don't file it. You get into the Delinquent Filer Correction Program, and as you can see on the bottom part of the screen, the penalties there are quite reasonable. $2,000 a year if you have a large plan, which is usually with more than 100 participants, and buy two, get the rest free means that even if you're 5 years or 10 years delinquent, you'll only pay $4,000 for a large plan or $1,500 for a small one. The rest won't cost you anything. And that can happen. Let's say you have a health plan. You may not even be aware that your health plan, you have a contract with a major healthcare provider. If you have over 100 participants, you've got to file Form 5500 for your health plan, even though there's no audited financials to be attached. So if you find that out way down the road and you're 5 years or 10 years in arrears, what you want to do is get into the Delinquent Filer Program, and you can get out for a relatively small fee. The last bullet point is a top hat plan. You may have that and not even realize it. A top hat plan is one of the non-qualified plans we referred to earlier. It's a specialized plan for executives of a company. And if you have one, you're required to file a statement with the Department of Labor within 4 months after creating a top hat plan. And if you haven't done that, didn't know you were supposed to, again, you have a delinquent filer situation. So this is what the program is for. And if you have a late return situation, you may want to consider this now. Do you have a health plan that should be filing and has not? Do you have a top hat plan? Certainly the DFVC program is the place to be. Now, what happens if you are audited by the Department of Labor or the IRS? Starting with the Department of Labor, they call their audits investigations, and I think the reason for that is that for many years they were targeted audits, which is to say they would only come after a plan if they had explicit reason to suspect that there was an issue with that plan, and they would come in and investigate that issue. In more recent years, these have also become random, which is to say they will just come in with an open-ended request list for multiple years, multiple issues, and they will audit you at random, much like the IRS does. And you can be sure of one thing, that after the Department of Labor is done with your plan, if there are any problems, you really need to get them corrected relatively soon, because they do refer the matter to the IRS, and the IRS will come knocking on your door a year or two later. So certainly in the interim between the first audit and the second, you're going to want to have any issues corrected if you had them. I think Deb has a random DOL audit in progress right now, if you want to comment on that.
Right, I was actually very surprised because at the end of the day, the initial document request was comparable to something you would see from the IRS, where it covered multiple years, 3 years in this instance, and it was extremely lengthy, including they wanted to see the audited work papers, the auditor's work papers for those years as well. So it's extremely time consuming to prepare for this. And I think the important thing to take away is that if you've addressed everything that we've spoken about today, you'll be in a much better position for a smooth examination than if you had not addressed any of this at all.
So we've covered the DOL aspect. Let's look at IRS tax exams. As we said, they could be referred by the DOL. Otherwise, IRS audits are random. So we're frequently asked, what did we do wrong to trigger an audit? Or what should we avoid doing so we don't trigger an audit? And again, there's nothing you can do because they are random. We actually had a client that was audited. They had their plan audited 2 out of 3 years. First of the 3 years, the IRS audited the plan and there was nothing wrong with the plan. And the IRS said, okay, we're not making any changes, everything's clean. And then 2 years later, they came back to audit the plan a second time. And we said, well, you just audited this plan 2 years ago. Can you cancel the audit? There's nothing to find. And they said, no. Basically, you lost the audit lottery twice in 3 years, and we're going to come in and audit you a second time in 3 years. And they did. And once again, there were no problems found, but that just shows how random the process is. And all the more reason why it's better to get in front of issues while you can, so that you position yourself properly, that if the IRS does come in and audit your plan, they're not going to find much, if anything. Now, Anchin can certainly help you audit your plan, and we'll get into more detail about self-auditing a plan in a minute. We can do this. This does have particular value when we're not formally auditing your plan in order to do financial statements. So we saw at the beginning, many of you have small plans. You don't have audited financial statements. So you may have problems going on that you're not aware of, and you'll want to do that self-audit. We can help you with that, but if you're a self-starter, the IRS has excellent tools to help you self-audit your plan. Now, at the bottom of the slide, you see a link there to a checklist, which we'll show you on the next slide in a minute. You can copy that link, but if it's a little bit much, really all you need to do to get to that IRS checklist, you go to www.irs.gov, and on the search box in the IRS website, you type in publication 4531. Or you can even go to Google and type in IRS publication 4531. And what that's going to do is it's going to take you to this self-audit checklist. Now, I don't know how legible these questions are on the small screen. This is the first 8, and there are 4 more questions we'll show you also. But if they're not that legible, I'll just read through a couple of these items. The first one is, how has your plan document been updated in the past years? So you know Deb was talking about that, and it's very, very important. Are the plan operations based on the plan document terms, which we talked about? And then the third one has to do with definition of compensation, very critical area that we've talked about. Also matching contributions, non-discrimination tests is number 5, which is something that your plan administrator, if you have one, is going to calculate for you. So all of these items are going to be very valuable to you in self-auditing your plan. I'll just click to the next screen where the last 4 items appear. The first of these 4 has to do with participant loans that we talked about, hardship withdrawals, top-heavy contributions, which means your plan can't be designed to favor the highly compensated employees. It can't be discriminatory. And look at the last one there, was Form 5500 filed. So the IRS considered late filed returns or non-filed returns to be critical on their list enough that they wanted to put it on the checklist. And let me call your attention to the lower left portion of each of those questions, which is a very good reason to download the checklist. In the lower left corner of each box, it says more, and that's underlined. And what that enables you to do is, if you're doing your self-audit, you download the checklist and you think you have a problem with one or more of these issues, you click on more, and you're going to get a whole lot of additional detail on the IRS website about that particular issue and whether or not you should be concerned. And if you do have an issue, it's going to tell you exactly what you need to do to get it corrected. So that's very valuable. I certainly encourage you to go through this process, in particular if you have one of the plans that's small enough that you don't need a certified audit by an accountant, and even more so if you're one of the group that's not working with an outside plan administrator. So that's going to be a valuable process for you. And I think that's going to bring us to our last polling question. Just like to get a sense of how widespread the audit issues are. Has your plan been audited by the Department of Labor or the IRS, let's say in about a 5-year period? So preliminary results are that over 10% of them have been. So, we have quite a few people signed up today and listening. So the fact that even 10% of you have had your plans audited says that it's a very real possibility. And it underscores all of that we've been talking about, self-auditing your plan and getting into the available correction programs. And if you're fortunate enough that you haven't had it audited yet, certainly you can see it's a possibility and you want to be prepared for that. So we have a few moments left. We would like to get into some of the questions that you've been nice enough to submit. I like this first question here. It says, Deb, who's going to win the Super Bowl and why?
I guess my question is, who's playing?
Who's playing?
Then I have a 50-50 shot of getting it right.
Deb will get back to you right after the game with the answer to that question. Here's one for me. It asks how large the penalties are if your plan is audited by the IRS or the Department of Labor. So we're not talking about the penalties for filing a 5500 late, which we quantified, but more what happens if they audit your plan and find a problem? What's it going to cost you? It's an interesting question. It really depends on the magnitude of the problem. There is an IRS form to file. It's Form 5330. It's an excise tax form that covers all sorts of plan issues, and the excise tax is usually 15% of the problem. And when we say the problem, let's say you didn't match um, your employee's contributions on a timely basis, if at all. There's an opportunity cost because they didn't get the money they were supposed to when they were supposed to, or let's say plan contributions were remitted late. There's another opportunity cost. So whatever the cost is to the employees for your plan error, what it costs to make them whole, usually 15% of that is going to be excise tax imposed on the plan, and that can be obviously a little or a lot. In the most egregious situation, Deborah talked about possible plan termination. That's very, very unusual. The IRS does not want to terminate your plan because then they're penalizing the plan participants and they're innocent parties. So what they might make you do is say you're close to plan termination, we won't actually do it. But technically, a retirement plan is a trust. It's a tax-exempt trust. So they might make you fill out a tax return. We have had to do this. You fill out a tax return for a trust, and you compute the income and losses of this plan as though it was a trust, and the net income yields a tax as though it was a taxable trust, and they base the penalty on that tax. So again, that could be a low number or it could be a very significant number. So the cost is wide ranging, but it can definitely get costly depending on how egregious the errors are.
All right, I have a question here. If I have a prototype plan and check the wrong box on a new adoption agreement that changes the definition of compensation, is there any way I wouldn't have to make a correction? Well, I think in either instance, you will have to make some type of correction. The question is what type of correction? And that's really where you have to consult with your ERISA attorney. A lot of things turn on what the actual facts and circumstances are. So if you had particular communication to the participants that the old box that you checked is the way that you're going, you might have something to hang your hat on, and maybe you have to retroactively amend that kind of current plan where you checked the wrong box. But that's something that really a risk attorney has to go through. The only good thing is under one correction, you may have to put money into the plan, so there'll be a cost to the company, whereas under the other correction, it might just be more of a paperwork correction.
I've been asked how to get into the delinquent filer program. So at least one of you does have a situation with a late filed 5500. I did talk at some length about the program, but I guess I didn't say how to actually get into it. What you'll want to do is just go to the Department of Labor website, which is www.dol, Department of Labor, www.dol.gov, G-O-V, and that's going to take you to their site where you can type into the search box Delinquent Filer Program or DFVC, Delinquent Filer Voluntary Compliance. So dol.gov, type in Delinquent Filer Program into the search box. It will take you to a page with all the information you need. It's going to tell you how to file your delinquent return. It's going to tell you how to check the box that says you're in the delinquent filer program so that when you submit the late return, it won't be viewed as a late return. It will be viewed as an amnesty return with a much lower penalty. It'll even tell you how to electronically pay the penalty. So this is actually much easier than it used to be, where you had to mail a lot of paperwork to one address with the retroactive returns. You had to mail a check to another address with copies of the returns. It's really pretty quick and painless and seamless, and the penalties are reasonable. Of course, if Anchin is your accounting firm, we can certainly help you with that.
Okay, I think we're out of time. Thank you all for joining us this morning. Our contact information is here on the screen, so please feel free to get in touch should you have any further questions. For those of you who asked questions that we were not able to get to, we will email you directly with your answer. And we also will be posting a recording of this webinar on our website, and you will receive an email later with a link to the recording. Thank you again for joining us, and have a great day.